24 hours ago, silver was trading at $120 per ounce. It was touching the sky. It was breaking records that analysts said would take years to reach. The charts looked parabolic. The momentum was unstoppable. And then, this morning, you woke up. You checked your phone. And the number on the screen said $95. Not 99, not 103, 95. In less than a day, silver lost 17% of its value. That is not a correction. That is not profit-taking. That is a liquidation event. That is the sound of billions of dollars evaporating in real time because one man's name was announced. Kevin Warsh. If you were not paying attention to financial news yesterday, that name means nothing to you. But to the traders who were long silver, to the funds that were betting on continued dollar weakness, to the people who believed that the Federal Reserve was about to cave to political pressure and slash interest rates to zero, that name is a nightmare. Because Kevin Warsh is not the dovish, market-friendly, money-printing Fed chair that everyone was expecting. He is the opposite. He's a hawk. He's an inflation fighter. He's a man who sat on the Federal Reserve Board during the 2008 financial crisis and argued against the very policies that saved the banking system because he was worried about the long-term consequences of printing too much money. And now, Donald Trump has chosen him to run the most powerful central bank on the planet. Let me be very clear about what happened. This was not a random sell-off. This was not technical weakness. This was a massive, coordinated unwinding of one of the largest trades in the financial system. This was a bet being liquidated at light speed. For the last 6 months, the trade on Wall Street has been simple and seemingly bulletproof. Bet against the dollar, buy commodities, buy gold, buy silver. The logic was ironclad. Trump wants a weak dollar to help exporters. Trump hates Jerome Powell and wants him gone. Trump will install a puppet at the Fed who will cut rates no matter what inflation does. And a weak dollar plus low rates equals exploding commodity prices. It was the debasement trade. And it was working beautifully, until it wasn't. The rumors started circulating late Thursday. Bloomberg reported that Trump was preparing to nominate Warsh, and within minutes the dollar started to rally. The precious metals started to crack. By the time Trump made it official Friday morning, the dam had already burst. Silver, which had been the star performer of the entire rally, became the biggest casualty. It fell harder and faster than gold. It fell harder than platinum. It fell so hard that some of the leveraged silver ETFs lost more than 20% of their value in a single morning. The ProShares Ultra Silver Fund, which uses leverage to amplify returns, dropped 22%. If you were holding that overnight, you just watched a fifth of your account disappear before you finished your coffee. But why did Warsh cause this? Why does one man's name trigger a 17% crash in a commodity that was in the middle of a historic supply squeeze? Because markets do not trade on reality, they trade on expectations. And the expectation, the hope, the prayer that every precious metals bull was holding on to was that the next Fed chair would be someone who prioritized growth over inflation, someone who would keep rates low, someone who would let the dollar weaken, someone who would, intentionally or not, create the perfect environment for hard assets to go to the moon. Kevin Warsh is not that person. Warsh has a reputation. During his time at the Fed, he was known as one of the most hawkish voices in the room. He consistently argued that the central bank was taking too many risks. He warned about asset bubbles. He warned about moral hazard. He was the guy saying, slow down, think about the consequences. Do not let short-term political pressure drive long-term monetary policy. And now, that guy is about to be in charge. The market looked at that and said, if Warsh is running the Fed, rates are not going to zero. The dollar is not going to collapse. The debasement trade is dead. Sell everything. Sell now. This is where I need to explain what the debasement trade actually was. Because if you do not understand that, you will not understand why this crash is so violent. For the last year, a large portion of the smart money, the hedge funds, the family offices, the sovereign wealth funds, has been positioning for a scenario where the United States government effectively admits that it cannot pay its debts without inflating them away. The national debt is $36 trillion. The interest payments alone are over $1 trillion a year. And Trump, who has never met a deficit he did not like, is proposing tax cuts and spending increases that will make the problem worse. The only way out, the only politically feasible solution, is to let inflation run hot and erode the real value of the debt. That means a weaker dollar. That means higher commodity prices. That means owning gold and silver is not just a hedge, it is the trade. But that trade only works if the Fed cooperates. If the Fed keeps rates low and lets inflation run, if the Fed prioritizes employment and growth over price stability, if the Fed, in other words, becomes an arm of the Treasury Department instead of an independent institution. And for a while, it looked like that was exactly what was going to happen. Trump was openly attacking Powell. The Justice Department was investigating Powell over construction cost overruns at the Fed's headquarters, a move that looked like pure intimidation. The speculation was that Trump would replace Powell with someone loyal, someone who would do what they were told, someone like Kevin Hassett, Trump's top economic advisor, who has consistently argued for lower rates. But Hassett did not get the job. Warsh did. And Warsh, whatever else he is not a yes man. He has credibility with the financial markets. He has a track record of independence. He has publicly criticized the Fed for being too political. And the market is interpreting his selection as a signal that Trump, despite all his rhetoric, is not going to completely destroy the Fed's independence. That maybe, just maybe, there are still adults in the room. And if that is true, then the debasement trade is not just wounded, it is dead. Now, let me show you what this looks like in the data. Because numbers do not lie. Silver opened the day at $119. Within 30 minutes, by 8:30 in the morning Eastern Time, it was at 103. That is a $16 drop before most Americans even woke up. By 9, it was at 98. The $100 level, the psychological fortress that bulls had been defending, crumbled like it was made of paper. It briefly broke below 95 before finding some footing around 99. That is a $25 intraday range on a metal that usually moves $2 on a busy day. This was not normal trading. This was capitulation. This was forced liquidation. This was margin clerks making phone calls. And the panic was not limited to silver. Gold dropped 7% at one point, falling below $5,000. Platinum fell 10%. Palladium fell. The entire precious metals complex was on fire. And the mining stocks, the companies that actually dig this stuff out of the ground, were absolutely demolished. Fresnillo, the world's largest silver producer, fell 4%. Endeavor Silver fell 9%. Kerr Mining fell 8%. These are companies that should, in theory, be printing money at these silver prices. But their stocks are collapsing because the market is pricing in the possibility that the rally is over. And here's the question that everyone is asking right now. Is the rally over, or is this just a correction? Is $95 the new floor, or is it a rest stop on the way back to 70? The bulls, the people who are still long silver, are pointing to the fundamentals. They are saying, look, nothing has changed. The supply deficit is still real. Industrial demand is still strong. China is still buying. India is still buying. The physical market is still tight. One Fed chair announcement does not change the fact that the world is consuming more silver than it is producing. The rally might pause, but the structural drivers are still in place. This is a buying opportunity. The bears, the people who just made a fortune shorting into this crash, are saying the opposite. They are saying the fundamentals never mattered. The rally was always driven by speculation. It was driven by ETF inflows. It was driven by the belief that the dollar was going to collapse. And now that belief is gone. Warsh is a hawk. Rates are going to stay higher for longer. The dollar is going to strengthen. And silver, which is more volatile than gold, is going to give back all of its gains. If $100 does not hold, they say, the next stop is 80. And if 80 does not hold, we could see 60. I do not have a crystal ball. I do not know which side is right. But I can tell you what the technical picture looks like right now, and it is not pretty. Silver just broke through the $100 level, which was supposed to be a major psychological support. When a market breaks a round number like that, especially after a parabolic rally, it often signals that the momentum has shifted. The moving averages are rolling over. The RSI, which measures whether a market is overbought or oversold, was showing extreme overbought conditions just 2 days ago. Now it is plunging. The volume on the sell side is massive. This is not a few retail traders hitting the sell button. This is institutional money exiting. But here's the thing about crashes. They are emotional. They are driven by fear, and fear creates opportunities. If you believe in the long-term bull case for silver, if you believe that the supply deficit is real and that industrial demand is going to keep growing, then a 17% drop in a single day is not a reason to panic. It is a reason to get excited, because the market just handed you a discount. The question is, do you have the stomach to buy when everyone else is selling? Do you have the conviction to step in front of a falling knife? Let me give you some context on Warsh, because understanding this man is absolutely critical to understanding where the market goes from here. Kevin Warsh is 55 years old. He was appointed to the Federal Reserve Board of Governors in 2006 at the age of 35, making him the youngest governor in history at that time. He served until 2011, a period that included the worst financial crisis since the Great Depression. During that time, he was part of the team that managed the response to the meltdown, but he was not a cheerleader for the policies that were implemented. He was openly skeptical of quantitative easing, the program where the Fed bought trillions of dollars in bonds to inject liquidity into the system. He was worried about the precedent it set. He argued that the Fed was taking too much risk onto its balance sheet and that the long-term consequences, the moral hazard, the asset bubbles would be severe. He was right about some of it. He was wrong about others. But the point is, he had the courage to dissent. After leaving the Fed, he became a fellow at the Hoover Institution, a conservative think tank, and a lecturer at Stanford. He has written extensively about monetary policy, and his views are clear. He believes in sound money. He believes in central bank independence. He believes that inflation is the cruelest tax because it hurts the poorest people the most. He is not a populist. He's not going to cave to political pressure. And that makes him, in the eyes of the Trump administration, a risky choice. But it also makes him, in the eyes of Wall Street, a credible choice. And credibility matters. The market is betting that Warsh will prioritize inflation control over growth. That means rates are going to stay elevated. That means the dollar is going to stay strong. And that means commodities, which are priced in dollars, are going to face headwinds. But there is a flip side to this. If Warsh is as independent as his reputation suggests, then he is also not going to be a puppet for the administration. He's not going to cut rates just because Trump tweets at him. He is going to follow the data. And if the data says that inflation is cooling and the economy is weakening, he will cut rates. But he will do it because the economics justify it, not because the politics demand it. That is a very different dynamic from what the market was expecting. So where does this leave us? The crash in silver is a brutal reminder that momentum can reverse in an instant, that parabolic moves are inherently fragile, that when everyone is positioned the same way, leaning the same direction, a single piece of news can trigger a stampede for the exits. The herd moves as one, and when the herd panics, people get trampled. But it is also a reminder that markets are not rational. They overshoot in both directions. They operate on emotion as much as logic. Silver at 120 was probably too high, driven by FOMO and leverage. But silver at 95 might be too low, driven by panic and forced liquidation. The truth, the fair value, is probably somewhere in the middle. And the traders who are going to make money in the next phase are the ones who can stay calm, ignore the noise, and focus on the fundamentals. The debasement trade might be dead, but the supply deficit is not. The industrial demand is not. The geopolitical uncertainty is not. And those forces are going to continue to support higher prices over the long term. The question is whether you can survive the volatility in the short term, because crashes like this are designed to shake you out. They're designed to make you doubt your thesis. They're designed to make you sell at the bottom so that someone smarter can buy from you. Kevin Warsh is now the most important person in the precious metals market. His decisions will determine whether this crash is the beginning of a bear market or just a violent correction in an ongoing bull market. The market will be watching every speech he gives, every testimony he delivers, every data point he emphasizes. And silver, which is the most volatile and the most sensitive of the precious metals, will be the first to react. If you are holding physical metal, this crash is just noise. If you're trading futures or ETFs, this crash is a wake-up call. The game has changed. The easy money has been made. From here, it gets harder.